Hello guys, welcome to Unacademy. Okay, this is the series we are starting from today. What we are doing, we are revising all the Indian economic concepts. Okay, for your prelims 2021. You know, prelims is approaching very fast. It's on June 27. Yes. Okay. So, and you know how important economy is for your prelims. Okay, it is very important. At least 20 to 25 questions you will get just from economy. Okay, and if you know the concepts, economy is all about concept based. If you know the concepts, you can easily answer the questions. Yes, and this series is presented by me, Rajshekhar. Yeah, I have a 2 years of teaching experience in various coaching institutions in Bangalore and other cities, and I did my BTech in and this in this lecture we will discuss on monetary aggregates. Okay, especially the monetary policy and the monetary aggregates. Okay, what all we see in the monetary policy, RBI, how they control the monetary policy, how they control the money supply with the use of monetary policies. What are all quantitative tools we have? What are all qualitative tools we have? Yes, good afternoon, Ram Kumar. Welcome to the class. Yes. Yeah, see here, and there is a Unacademy combat next Sunday at 11 a.m. It will be a Unacademy combat, and you can use this code RAJUBG to get enrolled into Unacademy combat. And there is a offer, guys. Like yes, there is a offer. You can use this offer till April 28. You can enroll in this batch till April 28 so that you will get a subscription, extended subscription till July 31, 2022 or till prelims 2022, whichever is later. Till there you will get this offer. Yes, and you can use this code RAJUBG to get the discount on your subscriptions. Okay, let's start this class. Yes, the new batches are starting from 7th of April. From today, the new batches are starting. You can get into the new batches. If you want discount, use the code RAJUBG. Yes, and yes, you can log in for the 12-month batch, 24-month batch, 36-month batch, whatever the batch. You can use this code to get the discount. You can use this code RAJUBG. Yes. So let's crack it. Let's start the session. Okay, what I will discuss in this, okay, this is my code. You can use this code to get the discount. Okay, what I will discuss in this lecture, what is monetary policy, who will do the monetary policy, okay, what the RBI have the authority, what authority that does the RBI have to do with the monetary policy. Okay, yes, I will discuss this in today's class. What is monetary policy? Monetary policy is a macroeconomic policy that is related to monetary matters, that is related to money matters. Yes, and in case of every countries, who will control the monetary policy? Especially the central bank. Usually, the central bank in all the countries will control the monetary policy. In case of India, which is our central bank? RBI. RBI is the regulator of monetary policy in India. Okay, so what all we will discuss in this class? We will discuss what is monetary policy. Monetary policy is a macroeconomic policy related to monetary matters, and its main aim is to control the money supply and inflation. Okay, like when you remember Urjit Patel, when Urjit Patel was RBI governor, when Urjit Patel was RBI governor, at that time he told we will control inflation and we will control money supply with our monetary policy. Then everything else will be controlled. Yes, who is the present RBI governor? It's Shaktikant Das. Today they have something called as bi-monthly monetary policy. announcements. Today they had that announcement. In that announcement, they told the repo rate is unchanged. Okay, today itself. Okay, the Shaktikant Das came and told the repo rate is unchanged. Yes. Okay. So how many reports we will give? We will give bi-monthly reports. Every 2 months we will give those reports. What is the present repo rate, what is the present bank rate, what is the present CRR, what is the present SLR, that we will indicate every 2 months. So in a year, 6 bi-monthly reports will be released by RBI. Yes, in a year of 12 months, 6, yeah, 6 bi-monthly reports will be released by RBI. Okay. Then who will decide all the rates? Who will decide the repo rate? Who will decide the bank rate? Yes. Who will decide CRR? Who will decide SLR? RBI governor himself doesn't decide all this. We have something called as Monetary Policy Committee. See here, MPC, Monetary Policy Committee. Yes. Monetary policy, for every 2 months they will join a meeting, and this monetary policy consists of 6 members. This monetary policy consists of 6 members, 3 members from RBI side and 3 members from government side. Okay, even this is important, remember this. Yes. Okay. Or I can tell you in detail about monetary policy committee. Okay, I will tell you this. In India, who will decide who will decide the rate of the quantitative tools? Okay, it is decided by Monetary Policy Committee. See here, I'm writing here. It is decided by Monetary Policy Committee. This Monetary Policy Committee will have 6 members. In these 6 members, 3 from RBI side. In these 3, one will be RBI Governor, that is President Shaktikant Das. One will be Deputy Governor, and one who is appointed by RBI. Yes, in these committees, one will be this. Okay, 1 second. Okay, I will explain this in detail, because once the question was asked on Monetary Policy Committee itself. Okay, see here. Okay, and 3 members from RBI side and 3 members from government side. In that, there will be 3 members appointed by government. 3 members appointed by government. Okay, remember this, there is no finance minister in this committee. I am telling 3 members. Usually they will appoint retired IAS officers and one who is having a deep knowledge in economy. Those will be appointed in 3 members committee. There will be no minister and there will be no finance minister. Remember this. But in 3 members from RBI, governor will be there. So what happens? These 6 people will conduct a meeting every 2 months. Every 2 months, these 6 people will conduct a meeting and they will decide what should be our repo rate. I will tell you what you mean by repo rate in the later class. What should be our repo rate? Okay. At that time, what happens? Yes. Yeah. At that time, what happens? What happens if 3 people say one thing? If 3 people say let it be 6%, if 3 people say let it be 4%, which will be taken? Do you know what is the current repo rate? Anyone? Ravi, welcome to the class. Good evening. What is the current repo rate today? They announced the repo rate. They left the repo rate unchanged at 4%. The current repo rate is 4%. Okay, what happens if 3 people say 6% and 3 people? At that time, governor will decide the final decision. Governor have a casting vote. Governor have a casting vote and he will decide, and the governor will decide what should be the repo rate, what should be the CRR, what should be the SLR. Yes. Got it? This is all about Monetary Policy Committee. Yes, is that clear? Okay. Then there are two types of instruments in our monetary policy. One is your quantitative tool. Yes, another one is your qualitative tool. We will see what are those. Okay. In quantitative tools, we have many tools. Okay, some we will call it as cash reserve ratios. Some we call it as some group of quantitative tools. We call it as liquidity adjustment facility. Okay. Reserve ratios means two types. One is CRR, another one is SLR. Okay, remember this, there is a good difference between CRR and SLR. Okay, current CRR is 3%, current SLR is around, okay, no need to remember the exact term. Yes, current SLR is around 17%. Okay, so what happens? What is CRR? CRR is that amount the bank should go and keep it with RBI in the form of cash only. Okay, 3% of their net demand and time liability, they should go and keep it with RBI in the form of cash only. Then what is SLR? This is 17% of net demand and time liability. They should go, they can keep it with themselves, but they should not give this as loan. Okay, yeah. Liability means deposits. Sir, what is liability? What are you calling liabilities as? Liabilities means if you go and deposit 1 lakh in SBI, that is a liability to SBI. Okay. Consider you are the only one depositor. You go and keep 1 lakh in SBI. So they have 1 lakh with them. In that, 3,000 they can't give it to anyone. 3,000 they should go and keep it with RBI in the form of cash only. That is CRR. Yes. And this 17,000 they can keep it with themselves in the form of cash or in the form of gold or in the form of government securities. Yes, or in the form of government securities. So in 1 lakh, 3,000 should be kept aside, 17,000 should be kept aside. So in 1 lakh, they left with only 80,000 to give loans to other customers. Yes. Okay. So what is the difference between CRR and SLR? This they should go and keep it with RBI in the form of cash only. This SLR, this 17,000 they can keep it with themselves in the form of cash or in the form of gold or in the form of government securities. Is that clear? Yes. Another difference, in cash reserve ratio there is no interest rate or profit on this bank. You will go to RBI and you will keep the money in terms of cash, but RBI won't pay you any interest for that. They will not pay you any interest for that. You should just keep it as a idle money. Whereas in case of SLR, okay, bank can earn the interest on this. Bank can earn interest. Here there is no interest on CRR. Yes, is it clear? Okay, this is all about CRR and SLR. Two quantitative tools we did with. Okay, then comes liquidity adjustment facility. In that you will get repo, reverse repo and marginal standing facility. What do you mean by this? Okay, understand this. Liquidity adjustment facility, by the name you can say why we will use this to adjust the liquidity of money supply. Okay, then sir, tell me what do you mean by liquidity? What do you mean by liquidity? Anyone? Okay, see here, liquidity means, what do you mean by liquidity? Liquidity means amount of money, amount of anything that can be easily converted to cash. Amount of money in the market. If in the market the cash is more, then the liquidity is more. If in the market the cash is less, then the liquidity is less. Yes, is that clear? So this liquidity adjustment facility have three tools. One is repo, reverse repo, and marginal standing facility. What do you mean by these three? First, we will see what you mean by repo. This is important, okay? Repo is important in your quantitative tools. In all of your quantitative tools, repo is important. What is repo? If banks need some loan, they will go to RBI. They will go to RBI to buy some loan. And what is the interest rate they have to pay to RBI? That is called as repo rate. Now, the present repo rate today, Shaktikant Das announced it's 4%. Our RBI governor announced the present repo rate is 4%. Okay, then what do you mean by that? If bank goes and take 1 crore of what? 1 crore of loan with RBI, they should pay the interest of 4%. What is the 4% of 1 crore? They should pay 4 lakh as the interest. Yes, the rate at which banks buys from RBI on short-term basis. Usually it will be short-term basis. Short-term in the sense how much? See, usually it will be 0 to 14 days. Overnight to 14 days. Okay, this we call it as repo. Okay, then what is the banks must then if they are taking a loan, RBI wants something as collateral. How they can believe the banks whether they will repay or not? So RBI wants something as collateral, so they will keep government securities as collateral to buy those securities bank to end of prescribed period, generally overnight. Yes. Then what is reverse repo? This is exactly reverse of repo. If RBI wants money, they can get it from banks. Banks give money to RBI and RBI will pay some interest on this. This interest rate is called as reverse repo. Yes, is that clear? This interest rate is called as reverse repo. Okay, usually there is a relationship between reverse repo, and MSF. Understand this relation and remember this relation. Usually reverse repo will be lesser than repo and repo will be lesser than MSF. Okay, yeah, the current repo rate is 4%. The current reverse repo rate is 3.65%. Current MSF rate is 4.25%. In increasing order, I mentioned this in the increasing order. Usually this will be the case. Okay, see, usually it will be repo minus 1, not 1. Now we did with this, it will be not minus 1, it is now minus 0.35. Repo minus 0.35, it is plus 0.25. Yes, usually we call it as basis points. It is 35 basis points difference between reverse repo and repo, and there is a 25 basis points difference between repo and MSF. Yes, okay. So marginal standing facility is that rate. Okay, you got about reverse repo. Okay, what happens if RBI, if banks want the urgent money, and they have took many loans under repo rate, at that time they will go with MSF. MSF is that rate where banks can buy money banks can take money from RBI, and that interest rate they should pay to RBI, that is called as MSF. Yes, you got it about MSF? Yes. Usually MSF will be higher than repo. Okay. Yeah. Okay. Then next question. Next quantitative tool. Okay. Now we discussed about these tools. We discussed about CRR and SLR. These tools we call it as reserve ratios. And then we discussed about reverse repo and MSF. These tools we call it as liquidity adjustment facility. We did with 5 quantitative tools. Okay, any doubts in this? Any doubts in these 5 quantitative tools? Any questions? Okay, then we will see what is bank rate. Bank rate is that interest rate. It is as same as repo. Bank rate is as same as repo, but this is for long term. I told you repo is for short term and this is for long term. Yes, bank rate refers to official interest rate at which RBI will provide loans to the banking system. Sir, please say once more MSF. Okay, you have a doubt about MSF? Okay, see. Okay, see, I will tell you this. Anyone have want explanation on MSF? See this one. Usually repo and MSF are same, but MSF there will be high interest rate. You can see here repo is 4%, but as MSF is 4.25%. MSF is also that rate. MSF is also that rate where the banks are taking money from RBI. Banks are taking money from RBI. Okay, if they are taking money from RBI, they should pay some interest. This is the interest they are paying to RBI. That interest rate is called as MSF. Sir, when we have repo, why we need MSF? In repo, there will be certain limit. Consider bank can borrow only 100 crore with repo rate. Okay, what if they need more than 100 crore? What if the banks need more than 100 crore? Then also they can take, but they should take at that time it will be on MSF, not on repo. Is that clear? The difference between MSF and repo rate. Both are short-term loans. Both are taken by banks from RBI, and both are interest rates that a bank is paying to RBI. Any doubts? Is that clear now? Yes. So we did with CRR, SLR, reverse repo and MSF. Now the next quantitative tool is your bank rate. See, I told you both this repo and MSF are short-term loans. Then what if banks want long-term loans? What if banks want long-term loans from RBI? So that rate is called as bank rate. For long-term loans from RBI, yes, see, bank rate refers to official interest rate at which RBI will provide loans to the banking system, which includes commercial banks, the cooperative banks, development banks. Whichever the banks ask for the loan, they will provide loan to those banks. Yes. Then repo rate is the rate at which RBI lends to commercial bank by purchasing securities, while bank rate is the rate at RBI borrow without providing any security. Okay. There is one difference between bank rate and repo rate. See this difference. This is important. Sir, what is the difference between bank rate and repo rate? In repo rate, the banks are keeping government securities as collateral with RBI. Because if RBI is giving loan, then what is the surety that banks will give it back? So RBI should keep something as a security with them. So what they will keep as a security? They will keep this government securities as the security with RBI. Well, they go to RBI for repo rate. What the RBI will ask? Keep some government securities as the collateral. Then only we will give loans. Yes. But in case of bank rate, if you want to take a loan in case of bank rate, then no need for banks, no need for banks to keep this government securities as collateral. Yes, in bank rate, RBI is not asking any collateral from the banks. Yes, okay. Then recently we introduced something called as long-term repo operations, because I told you repo is only for short term. Repo is only for short term. What they decided, yes, we should give for long term. So they introduced LTRO, long term repo operations. This is as same as repo. If repo is 4%, then it is also 4%. Yes. So usually repo loans are for short term borrowings for overnight. Usually repo is for overnight to 14 days. But this is for long term. In 2020 February, we announced this in 2020 February. Interest rate is equal to repo rate. Okay, yes. Then thus will be increasable loanable funds, economic growth can be revived. Okay. MSF and both MSF and repo are short term. That's why we introduced LTRO from Feb 2020. RBI introduced another quantitative tool, that is long-term repo operations, LTRO. Okay. Then another quantitative tool, open market operation. What do you mean by open market operation? In simple words, buying and selling of government securities by RBI is called as open market operation. Then why they will use this, sir? Okay, I will tell you this simple idea. See what happens. Consider buying. RBI want to buy the government securities from the market. What happens? RBI will go to the market. Market means economy, okay? RBI will go to market and they will buy government securities from the market. So from market, the government security is coming towards RBI. In terms of if they buy government securities, they have to pay money from whom they are buying. This is one case where RBI is buying the government securities. Another case, RBI want to sell the government securities. Means open market operation means buying and selling of government securities by RBI in the market. Yes. Now what happens? RBI, okay, wants to sell the government securities. Now government securities are going from RBI to market. At that time, what the market will do? Market will pay some money for this government securities. See these two graphs. See these two graphs. In this case, in the first case, the money is going towards the market. Yes. In the second case, the money is going towards the RBI. In these two cases, where the money supply will be increased in the market? In this first case or second case, the money supply will be increased in the market. Anyone? Okay, remember it is in the first case, that this case the money supply will be increased in the market because money is going towards the market. Money is going towards the market. Okay. In second case, what happens? In second case, the money supply in the market decreases in this case because money is going away from the market. From market to RBI, the money is going. So, what is the advantage of OMO? To control the money supply in the market by buying and selling the government securities by RBI in the market. Is that clear? Yes, you got the open market operation. Okay. Now, what is government securities? Okay, we discussed about GSEC, government securities. Then what is government security? What is government security? Okay, see here. Government security is one type of debt instrument. We call it as debt instrument. Usually what happens, you saw in current market, usually what happens, if you want money, you will give something as bond. You want money, you are going towards someone to buy, to take a loan. You will give something called as bond. What is that bond? You keep this bond, you keep this bond, I will pay you when I will pay you back the money. At that time you give me this bond back. So if government want money, if government want loan from anyone, even they will do this. They will give them something called as government security. You give me loan and I will give you government security. You give me loan, I will give you government security. Whenever I pay back, you give me back our government security. It is like a debt instrument. It is like a loan instrument they are using by government. Yes. Okay. Another last quantitative tool is market stabilization scheme. This we introduced to control inflation. Means whenever there is a inflation, there is more money supply in the market. To control inflation, in the sense to control money supply, to decrease the money supply, we use something called as market stabilization scheme. Okay, this is all about your monetary aggregates and quantitative tools of monetary policy. So yeah, tomorrow again we will discuss on economy daily at 1:30 p.m. We will be discussing this economy subject revision, complete revision, especially for your prelims 2021. Okay, we will do this. Yes, thank you for this.